So we've talked already about being careful to only consider the relevant revenues and costs, right? In other words, those that would be different in the future if you made this decision, right? And we've applied that to whether or not we should stop a segment. And in our example, it turned out no, because even though the net operating loss assigned to that segment was 100,000, when we took away the contribution margin, what it was covering of fixed costs, we wound up actually having an overall across the whole organization $40,000 lower net income. So you have to make sure you're considering the right information. So let's go ahead and think about this from another perspective, considering the right information for a make or buy analysis. So some organizations are what we call vertically integrated. In other words, they carry out more than one activity in the value chain. So think about, an energy sector, right? Like an ExxonMobil. They do exploration. They transport that oil and they refine that oil. And then that oil is turned into gasoline and kerosene and jet fuel and just all kinds of different stuff, motor oil, tar, and they transport that. And then they also retail it and wholesale it. So they're all up and down the value chain, a big energy type, right? But if you are a retailer and you're an ExxonMobil retailer, you could buy your gasoline from a different refinery that's not an ExxonMobil refinery. If you're ExxonMobil, you don't have to explore and drill and do all of that expense. You can just buy barrels of oil for your refinery on the open market, right? So a lot of companies are like this. Should I expand my supply chain and start doing some of this stuff myself? That's what we call a make or buy decision. All right. So vertical integration is nice, right? You're kind of got a smoother flow of parts and materials. I think if the pandemic showed us anything, it's that the supply chain can break down. Well, it showed us a lot of horrible stuff. Don't get me wrong. I'm not trying to be flip. It's bad. But one aspect that really came home, I think, to a lot of people was the supply chain. And I think some organizations have decided they want a smoother flow of parts and materials, right? Better quality control. If you make it yourself, you know what you're getting. And you may be more profitable, which is ultimately probably the main reason to make something or buy something, right? To realize better profits. So here's disadvantages. So if you're vertically integrated, you do everything or a bunch of stuff, and you're just doing it for yourself, right? Well, a big organization that does just that can probably take advantage of economies of scale and produce that thing cheaper than you can, right? So your Dell, and should you make the microchips that go inside your computers, or should you just buy them from Intel, right? Intel makes them for everybody. They make billions of chips. That's all they do all day long, every day. That's what they do. Should you just buy your chips from Intel and stick them inside your computers, or should you make them yourself? And just for you, right? Even though you make a lot of computers, it's certainly not on a worldwide global scale for everybody, right? So certainly um, a company that does nothing but that one thing, and for many, many, many customers probably can take advantage of that and have lower costs than you can, right? So you have to think about that, again, you need to make sure you can keep your supply chain locked in, that when you need those parts, or whatever it is that you're thinking about making yourself, you need to be able to be sure you can get them out of that vendor if you decide to buy, right? That's not an irrelevant part of the decision making, but in accounting, what we can look at are the numbers that are relevant. Okay, so let's look at this make or buy decision in an example. So we have a company that manufactures a part and they stick it in their products, right? So you can imagine it's anything. They make cars and they add the seat belts. They make computers and they add the chips, right? They make iPhones and they add the memory circuit. You know, it's just whatever, right? So there's something they manufacture, and when they manufacture this part, right, they've got the same thing as every material, labor, overhead, depreciation, some salary, some overhead, and it costs them $30 to produce one of these things. Then they stick it in their product and sell it, right? So the main thing they sell is this product, and it needs this part, right? So, and it costs $30 for them to make that part. Well, they use some special equipment that's got no value to anyone else. It makes this part for them. They can't sell it. General factory overhead would be unaffected. In other words, it's still, they're still going to have to pay general factory overhead. It'll just get allocated to something, to the whole product, right? Or some other products they make there, I don't, whatever. But that's the deal. So you got some equipment that makes the part, and you got some overhead. This 30 per unit is based on 20,000 parts. So that's, I guess we make 20,000, stick those in the thing and sell it, 20,000. Now there's a supplier who makes the same thing. They can sell us 20,000 parts for $25 per part. Well, should we just do that, right? Here we're making it for 30, and we can buy it for 25. Why wouldn't we do that? Well, we might not, because some of this stuff in here, right, is not going to be part of what we need to think about, right? Some of these costs can be avoided, right? Some of these costs can be avoided, some cannot. All right, so let's look at this. All right. So the easy part is, if we buy it, it's going to cost $500,000, and the total cost is going to be $500,000. All right. Now, let's look at the avoidable costs if we quit making this, right? Well, direct materials, we won't have that. Direct labor, we won't have that. Variable overhead, we won't have that. We don't have a supervisor anymore. But these other items, depreciation of the equipment, that's not relevant. It's a sunk, the machine is sunk, so its depreciation is just using that machine up over time, right? So it's the way we expense a capital asset. But that machine itself is a sunk cost, so we don't have to worry about that. And then general overhead factory, well, that's just going to go on ahead and become part of the overall thing, right? I mean, that's not going anywhere, right? So if we quit making this thing, right, we're going to save the variables, and we're going to save this supervisor salary. All right, so that means if we make them, it really costs us $340, right? To make these things doesn't cost us the depreciation, and it doesn't cost us the general factory overhead. That's all irrelevant. So here's what it costs us really to make these. It costs us $340,000 to make these parts, whereas if we buy them, it's going to cost us $500,000. So by just examining these avoidable costs and comparing it to what we'd have to pay, that tells us we should buy it, right? The avoidable costs, right, include these items, but we don't include the sunk cost of the depreciation affiliated with the equipment. We don't include the allocated general factory overhead, right? So it's irrelevant. So when we come right down to it, the financial advantage of making it is $160,000. So we should just continue making that part. And that doesn't even consider that, hey, we've got a guaranteed supply chain, right? It's like if something happens, if there was a pandemic or a barge got stuck in the Suez Canal, we don't have to worry, right? We're making that part ourselves. So that's not part of the financial decision, but it certainly is a benefit you might want to consider. Right? And another thing we did not talk about in this decision, which should possibly be included, but it's very difficult to quantify. So, but I do want you to think about this. So let's imagine that part of the factory where you've got that machine that makes the part. Well, if we just got rid of that machine, we'd have some square footage in the factory that we could rent out, right? So if there's something we're foregoing, we need to consider that, right? In this case, there was no mention of an opportunity cost. You know, maybe we can't rent that part of the factory out. Maybe it's just like a little corner over here and nobody's going to rent just that corner. But you have to think about that. Okay. Now, sometimes you have the opportunity to accept a special order, right? So generally you make things for retail or wholesale, I guess it doesn't really matter. You make them and you advertise them and you sell them and you have your customers and you're making them and selling to your customers. But sometimes you get an opportunity to do something, a special batch or something, and they want to negotiate the price. You know, normally you sell it for this price and that's what you sell it for. But they say, well, hey, I'm going to order a bunch and will you give me a better price? Well, you might, right? I mean, if you can sell a whole bunch of them and it's going to help cover your fixed cost, right? Maybe you do want to do that. Okay, a special order is a one-time deal, not part of your normal business. When you're doing a special order, only incremental costs and benefits are relevant, right? So if this is a special order, in other words, normally I'm using this factory to manufacture the stuff I sell. I sell this many units. Somebody comes along and says, hey, can you make me these units for this, a little different, right? Well, this doesn't impact my fixed costs at all, right? Fixed costs are about capacity. So if this isn't going to change my fixed cost, which it wouldn't, it's just a special order of some additional units. So it's going to impact my variable, but not my fixed. I don't have to worry about those fixed costs. So I just look at my incremental revenues and my incremental costs. All right. So here's a little example. We'll just look at that. So Jet makes a product, sells for $20. Some foreign distributor offers to purchase 3,000 for $10 a unit. Wow, that's half price. I don't know. One-time order, not affect our regular business, right? So in other words, this foreign distributor is going to take these away and not sell them to our customers, and it won't impact us at all. So should we do it? Right? Well, it's important to think about capacity, right? Because if we're selling them for 20, we don't want to use up our $20 capacity and make $10 ones. But hey, we can make 10,000 units. We're only selling 5,000, so we got room for another 5,000, and this is only 3,000. Should I accept this? Well, what I need to figure out is, will the revenue, $10 per unit, cover my variable costs? All right, so here's an income statement, right? So normally, right, so here's what's going on at my company right now. right? This is not the special order. It's just, here's my revenue, right? If it says I'm selling 5,000 per year, right? So this is from over here. Selling for 20, selling 5,000, right? And here they're telling you, okay, so you make 100,000. Here's your variables, right? Here's your contribution margin, and here's your fixed costs, right? And we end up with a net operating income of $12,000, right? So my variable costs are $8, right? If you take 40,000 divided by 5,000, 45, yes, is $8. So variable costs of these guys right here, they're $8 per unit. All right, so $8 per unit is what it costs us. So if somebody's going to give me $10 per unit, that's 30,000 incremental revenue. And I know it cost me $8, so 33,000 times 8, 24,000. So now I'm going to get 6,000 that I can add to covering my fixed costs. Now, assuming that there's no change to the fixed costs because of this order, right? There's no additional variable costs, right? We don't have to market, or somebody just came in and said, hey, I'll pay you $10 per unit. How about it? All I have to do is say yes or no. We should say yes, right? There's nothing, we don't, that's it, right? Okay, so let's skip this quick check. Let's look at this quick check. Northern Optical sells the X lens for 50. Fixed production cost is 18 per unit. A customer has requested a special order, 10,000 units. No selling costs. Would have to purchase an imprinting machine, right? So that's not quite the same thing. The rock bottom minimum should not go below. All right. So you've got your variable costs, 100,000, right? 10 times 10,000, right? Plus 50. So 150, right? Number of units, divide that into that. So 15. So at 15, we're breaking even. Anything we get above that is fine. All right. And when we come back on our next video, we'll talk about a few more decisions.